Paul Moore joins the show. He is a podcast host, author. He has his own show currently, a live setup on Bigger Pockets, and has been a longtime real estate investor, both in the multifamily, single family, commercial space. He's going to talk a little bit about what is his best insight and exit strategies and asset classes moving forward in the post-COVID market, and gives a little bit of a prediction there. He also is involved with Wellings Capital. That is a fund that he has currently. So definitely check it out and let me know what you think. Awesome. Paul, I hope you have a nice cold drink there as we're recording it here in Maryland and Virginia. It feels like 100-something degrees outside, man.
It is quite warm, my friend. That's for sure.
Well, I'm excited that we got linked up, man. I would love to hear what you're doing now and how you got into real estate. There's going to be a nice long story in there and plenty of experience and insight that will be beneficial for anybody that's hearing this. So we'd love to hear what you got going on now, and we'll backtrack how you got into real estate.
Okay, great. Right now, I am managing three investment funds at Wellings Capital. We're providing opportunities for investors to join us to invest in large commercial real estate, including self-storage, mobile home parks, and potentially multifamily. We have a Delaware statutory trust in addition to that allows people who have a 1031 exchange where they don't want to continue to manage the property or they're running out of time, they can join us in a fractional ownership model with a Delaware statutory trust. So that's what we're doing right now.
Very cool, man. Love that. Well, tell me, I mean, how did you get into real estate? We can go all the way back to your first job. I know that we're going to have a little bit of hopefully we can keep it civil. Like I said, I'm a Maryland UMD guy and a Miami football guy, so hopefully we can keep it civil. But
okay, great.
We'd love to hear your story, man.
Yeah, so I sold my company to a public firm in 1997 and came to Virginia and fuddled around a little bit, wasn't sure what to do, started a nonprofit organization, finally started flipping houses before flipping houses was really a big thing. We called it fixer-uppers. And we did a bunch of those. Then we did some single family rentals, built some houses from the ground up, flipped a whole bunch of waterfront lots here at Smith Mountain Lake in Virginia. And we were always trying to figure out, I was often trying to, ascertain, how do I get involved in commercial real estate? But I really didn't know who to trust, how to get in. Finally, built a multifamily facility in North Dakota, and we owned and operated that for a number of years. And while we were doing that, I realized I really do want to be in multifamily and commercial. I really don't want to be a ground up developer again, just too much risk. And so that's how I got involved, and that evolved into us building these funds to make this available to other investors.
Very cool. In addition to the risk, was there anything else that you preferred with the multifamily than building from scratch there?
It really was the risk. We actually had a very successful development, but 6 or 8 months after we sold the project for top dollar, the oil prices plummeted from $100 a barrel down to about 30. And I realized if we would have been holding those properties, we would have went from close to 100% occupancy down to a very, very low occupancy. And so I just realized, I want to do everything I can to mitigate risk. I was in my 50s by then, and I really didn't want to continue battling all the risks. So we wanted to get out of places that were dependent on oil prices. We wanted to, not be a developer, because the developer, again, bears the risk that things could, go wrong in the development process, or the whole market could change while we were building the apartments.
What are you looking for in a market that you're looking to invest in? I'm kind of asking that just as you mentioned, the dispreference or the lack of preference for some markets that you're in. What are you looking for now? And like we were saying, I think you can provide a lot of good insight just for like strategies on what to do with where we're at in the world right now. Hopefully through this first wave of COVID and everything.
Yeah. We're looking for positive net population migration. We're looking for low unemployment. We're looking for a diversified economy that's not dependent on one thing like automobiles or oil, for example. We like to see an economy that has some government, some healthcare, and some education. We want to see a place that has potentially barriers to entry for a lot of new product. That's especially important in self-storage, where it's easy to permit and build quickly. We like to see, places where there is a lot of new job growth, in addition to other net population migration, things like that.
Mm-hmm. I'm curious as kind of a side bullet point follow up question to that. How are you doing research with all those metrics? Is that something that you do personally, just as far as all the daily activities that you're doing now across across your companies and hosting a podcast and doing lives on Bigger Pockets and everything like that? And then what are like the best tools and resources to see all that? Because that's some pretty high level information, like the positive net population migration and
Yeah.
everything like that.
Yeah, we have an analyst who has been
Gotcha.
doing that. We don't actually do that type of work right now from what we're doing. We're focused on finding the very best operators and trusting them to do that type of research. That's how our fund is set up. However, backing up about 4 years, when we were looking for multifamily, we would use things like CoStar and TREP reports when we could get our hands on those. We would use our Real Capital Analytics. We would use the Texas A&M Real Estate Center. Texas A&M Real Estate site has a lot of great data on it for people. We would use the U.S. Census and other government information on population and unemployment, Bureau of Labor Statistics. We would use Neighborhood Scout to check crime in a submarket and also demographics, income in a submarket, things like that. So we used a lot of tools that were available like that. There's also, I can't think of what it is right now, but maybe sometime later in the show, I'll think of another tool or two that we really used that we liked. It's right on the tip of my tongue right now, Carlos.
Cool, man. And I know we're kind of going across a long timeline here because you got a long career. But for anybody watching this on YouTube, you may recognize Fall from HGTV House Hunters. I know I've definitely heard of that show before, and I saw your booking agent put that in there. But yeah, man, you've been in a bunch of different real estate asset classes and exit strategies here. I'm seeing that you also had some development with Hyatt Hotels, which of course is popular. Hotel company brand, however the wording is for that. I've definitely stayed there on some trips the last year. But yeah, man, I feel like you have a lot of insight. I definitely will make sure I have the link for Wellings Capital in the show notes as well, because I feel like that's a great type of investment, or the best type of investment, just when you have money that's sitting around and you just want to be, relatively passive and just have trusted people that are doing all this work for you as far as analyzing the markets, population, XYZ.
Right. Yeah, we are a due diligence company now. I mean, we spend an enormous amount of time doing due diligence on operators. And once we really trust somebody, we invest heavily with them. That's what we're all about right now at Wellings Capital.
Mm-hmm. So potentially some of your operators, that's kind of boots on the ground acquisitions. That'd probably be a lot of people that are listening to this show that are pretty much doing that on a smaller level in their market or virtually in multiple markets. So I'd be interested to hear kind of just what your take is on the real estate cycle right now, and kind of how COVID has impacted that, and what you're expecting to see with everything that you're doing. I know rent collections for some people have been hit, but maybe not as significantly as they first projected in March and April range,
Yeah.
things like that. I'd love to just hear some broad stroke insights from you.
Yeah, overall, people are quite surprised as we sit here in July and realized that rent collections have been relatively strong across the
Yeah.
board. Ken McElroy today talking. He's an apartment guru. He's got 8,000 tenants total in mostly apartments, a little bit of self storage, and he said 80% of his tenants paid on time, all the way up from February through now. 15% are asking for a little bit of extra time. They're on a payment program. They might be paying, a little bit overtime. And then about 5% are basically like, oh, we don't have to pay. I heard there's a rent strike. We don't have to pay. And they haven't been in communication at all. They haven't been paying. And so that's a pretty bad situation. But a lot of us are wondering what is going to happen when government assistance runs out. And that may be August, that may be after the election in November. But a lot of us are wondering, what's next? What's going to happen? How are things going to shake out? And it's looking pretty, I think it's looking pretty bad. I mean, I'm not really super hopeful for a V-shaped recovery where we're going to bounce right back. I mean, we've got record unemployment, and some stats say up to 40% of people who've been unemployed won't ever go back to that job. Wow, seriously.
It's crazy.
And we've got, this record pandemic. We have got record printing of new money. We've got all this stuff going on. And with that all happening at the same time, I really believe we're going to be in for something much more serious than 2008. But I really, from the bottom of my heart, hope that I'm wrong.
Yeah, I think we all do, but I really do, appreciate your insight since you've been in the game for so long. What do you think are the best things for investors? Maybe not even like asset classes or exit strategies. You can definitely include those and what you like about those, the asset classes, target, and exit strategies to implement in their businesses, in addition to wholesaling, if any. But what do you think is kind of like the best insight and maybe some stuff that you learned from 2008, from the last kind of like downturn?
Yeah, Carlos, I would recommend that people do subject to mortgages to build a portfolio, or lease option sandwiches as an alternative or as a close brother to that. So the subject to benefit, the benefit of that is you're not taking any debt on. You're taking very little, if any, equity requirement to get into these. You're basically picking up someone else's mortgage, and you're taking over payments, and you put in bold print right there in the contract that you may not be able to continue. At any time, you might have to hand the house and the mortgage back to them. But it's good for everybody. I mean, think about a lease option sandwich. It's good for the seller. This is a seller that hasn't been able to sell, or maybe it's expired a few times, or maybe they're on the courthouse steps in a few weeks and they're about to lose their home to foreclosure. It's really good for them. Even if you hand it back to them in a couple of years, they may be back on their feet and ready to take over mortgage payments again. So it's really good for them. It doesn't put a foreclosure on their record, which I believe, from what I've heard, is worse than bankruptcy as far as long-term damage to your credit. So it's good for the seller. It's good for the tenant buyer, because now a tenant buyer who can't get a mortgage, who can't qualify under the latest strict regulations, who had their credit damaged maybe from something that happened to them either at work or workers' comp claim, or they were out of work. So now the tenant wants to be in this certain school district. Now you can get them into a house in that school district instead of them having to downsize to an apartment or mobile home or whatever. So it's good for them. It's good for the bank, because the bank doesn't get this foreclosure now on their books they have to deal with. And it's really good for you as the middle person in this lease option sandwich, because you're coordinating all this, and you can build a portfolio of single family homes, potentially dozens of homes, with virtually no money out of pocket and no debt in your name at all. I mean, it's a real win-win.
Mm-hmm. A lot of people are getting helped on that deal. If you have leads coming in from your marketing too, just more of those you're able to monetize if you're doing the subject to or the lease option. because you're able to offer a higher price. I mean, there's just a lot of benefits to entering into a deal that way. Do you kind of want to walk through an example subject to release option sandwich, what that would potentially look like?
Yeah, I'll
And
do that.
now that you're thinking of it too, Paul, like those opportunities might be coming from the seller side. It may be more appetizing to the seller too if there is more foreclosure. If your prediction, what you're feeling with COVID and stuff,
Mm.
that's going to happen more if more people going into foreclosure.
Yeah, I think there's going to be more sellers and more buyers for
Yeah,
this.
more
And
transactions overall.
absolutely. I mean, when the
Yeah,
supply and the demand both go up, you could be in a position to scoop up a whole lot of benefit for yourself. And like I said, the buyers and the sellers and the banks. An example would be a deal we did in Roanoke, Virginia once. So the guy had a $140,000 balance on his mortgage. I don't know how many years he had left on it, but let's say 20 years left on his mortgage. He was $5,000 behind in payments. So a couple months behind. He was getting foreclosed on in about 2 weeks
hmm.
on the courthouse steps. We approached him. We said, what's your plan? He said, well, I'm moving out. I'm leaving the city. And so we said, okay, so if we catch you up on your mortgage, here's how it'll work. We'll put this into a land trust. We will be the beneficiaries of the land trust, but that's not a disclosed thing. In other words, the lawyer, only you as a beneficiary and your lawyer knows that. The deed will be transferred into the land trust. It will not trigger the due on sale clause as a result in the mortgage. By the way, I can't guarantee that. So don't go saying that, hey, you guarantee it. We just never
Yeah,
heard of one being triggered. And I know people who've been doing this for decades and never heard of one being triggered. So you put it in the land trust, you catch it up on the $5,000. We went in and we painted the front door, did a little landscaping, vacuumed the house, put it back on Craigslist the next day. The value at that time was about 180,000. So we said, hey, look, if somebody wants to buy it, you can buy it now for 180, or you can give us I think it was $8,000 deposit and move in as a rent to own. Now the payment on that, if I remember right, was about 800 or 850, and we were actually doing a rent to own for an $180,000 house for I think it was like 1,200 a month. So our first payday was when the person gave us an $8,000 deposit and we only owed five to catch up. So we made $3,000. Not a whole lot, but at least we were positive day one. Second payday was every month that they paid us, we were about $300 ahead of the mortgage. So that was a small payment every month. The third payday was when they closed in 3 years. We had an incremental clause in there that raised the price every year, which gave them a motivation to get their credit score fixed and close as soon as possible. But when they closed, it was 195,000. So it had gone up 5,000 a year for 3 years. And so they already had paid 8,000 down. We credited them a couple hundred a month out of their payment toward the down payment as well. And so they owed, let's say, $182,000. Well, the balance on the mortgage by then was 138,000. So 182 minus 138, I think that's like a $46,000, something like that profit that we made on our third payday. And that's how it worked. If they
that is.
wouldn't have closed, we would have just rented it to somebody else and started over. Sorry.
No, you're good. That was my very next question. I was going to say that's a beautiful way to get paid three times. And even though the 3K for the lease option folks out there, the subject to folks out there, it may seem low, even what Paul said. I love the principle of it, of still making money, just connecting the dots there. That
Right.
first time where you made $3,000 off the $8,000 down payment. So what's ideal for you? And I guess it's going to be different for different type of deals. We don't have to dive into this too much. We have a few points we want to hit on. I know you got to bounce to another show, but I guess there's benefits in both, kind of cashing out there at the end if you're able to make a sale, or if you just get another get someone else in there leasing the property.
Yeah, you can just make it a long-term rental as well. You don't have to do a lease to own. And then you can just keep renting it till the mortgage is paid off. Let's say that would be 20 years in that case. Imagine having 20 or 30 or 40 of these, and the mortgage pays off over time and you own them.
Yeah.
Pretty sweet deal. So that's another thing you can do if you want to build a single family portfolio with very little or really no debt. And, and very little equity out of pocket. The only disadvantage to that is you can't refinance it as you normally could refinance and take out equity along the way.
Mm-hmm. That's what my one good buddy here in Baltimore does with his multifamilies. He has 400 some units, but he's big into cash out refis and rolling that into other properties.
Okay.
Awesome, man. Well, we got about 10 minutes here before I got to let you go, man. But just a couple quick points to hit on. I did want to ask kind of your broad stroke opinion on self-storage. We know that you like the subject to the lease option type deals. I think everybody loves, in theory, the idea of getting paid at least 3 times, like on that last deal that you broke down. But we'd love to hear your mindset and philosophy on the self-storage.
Yeah. So I just wrote a book called Storing Up Profits, and it's going to be published by Bigger Pockets Publishing soon. But
Nice.
the theory on self-storage is it is a small part of anyone's income. And for, let's put it this way, if I was renting an apartment to you for $1,000 a month and I raised it by 6%, by signing that lease, you're signing up for $60 a month or $720 a year. But with self-storage, it's say $100 a month. If I raise your rent by 6%, you're only paying $6 extra a month, and you're on a month-to-month lease. And so as a tenant, you're probably thinking, hey, I'm going to be out of here in a few months anyway. I'm not going to take a Saturday, rent a U-Haul, get my friends together to move my stuff down the street just to save $6 a month. And of course, then they set it and forget it on their credit card until the next increase of 6% again, 8 or 12 months later. And so that's one of the reasons I love self-storage. In good times, people are filling up their Amazon or Walmart carts and they need a place to store their stuff. In bad times, they're downsizing from a 4,000 to a 2,000 square foot home or from a 2,000 to an apartment or mobile home, and they need a place to store their stuff. And so it really is quite recession resistant. I didn't say recession proof. The biggest downside to self-storage is if you get in a location where somebody else builds a new property unexpectedly right down the street.
Gotcha. Yeah, it makes it a pretty sticky product with
Right.
the example that you gave, just a $6 increase, and people are like, I'm not going to pay what may take 2 years of that delta $6 just to move my stuff around and get a lower rate. So that's pretty cool.
Right. Yep, it's very true.
Cool, man.
We talked to a guy who was going to invest, and he was a doctor, and he realized while we were talking, I've had a storage unit. It's been hitting my credit card for 6 or 7 years, and I forgot about it. And that's what convinced him to invest.
It's pretty funny. It's a good story to tell too for future investors.
Yeah.
Cool, man. Well, I would like to ask you any last advice or insight for the listeners, in addition to, I'll make sure I get the websites for like Wellings Capital, everything like that. Maybe best resources you can, I have your book link here as well, but maybe best resources on self-storage, subject to stuff, and then any closing words that you have for the audience. But you've given a great outlook already.
Well, people need to keep listening to your podcast, first of all, to learn all they can about this whole realm. I'd also recommend you check out Chris Prefontaine. He's got a book called Real Estate on Your Terms. And this is a book about the subject to lease option sandwich world. You also I think you had Joe McCall on your podcast before. Joe McCall's got something called Wholesaling Lease Options. And I think that's a great way to nuance this whole subject to world by just wholesaling it out. That's only one payday instead of 3, but you also have way lower hassle with something like that. So those are some things I would say as a parting thought. I know that most of your listeners are younger than me, and I'll tell you one thing I learned over the years is if you want to build long-term wealth, unless you're that 1 in 100,000 person exception, you should consider stopping speculating and investing. Speculating is when your principal is not at all safe and you've got a chance to make a return. Investing is when your principal is totally safe, or at least generally safe, and you've got a chance to make a return. And this is what Warren Buffett does so well. He builds in moats and margins of safety and things like that that allow him to really truly invest instead of speculate. And I really recommend that people consider that that's the slower but more reliable path to building long-term wealth.
Love it. As a personal question, what would you say is like the best resource for learning about long-term wealth and investing?
I would study Warren Buffett's annual letters. He's got about 55 of them, I think, out there on his website, Berkshire Hathaway's website. You can also read Snowball, which is his biography. Another great resource is getting on the list of Howard Marks. He's with, I think it's Live Oak. No, Oak Tree Capital Management. Oak Tree Capital Management. And Howard Marks has a book called Mastering the Market Cycles, Mastering the Market Cycle, Getting the Odds in Your Favor. And I think that's one of the best books I've read for really understanding market cycles and learning to build long-term wealth. For example, I mean, taking that thought and taking what you do, Carlos, if you are a non-informed investor, if you don't know anything about real estate, the best place to lose money is a place like Florida, where the generally uninformed people buy as the market's near the top. And then it takes this huge roller coaster crash down to the bottom and people lose money. Well, that's where real estate investors really shine, because they really can buy at the bottom or near the bottom and then sell at or near the top. And you can do that especially well in sand states like Nevada, Arizona, Florida, and California, where there's these huge roller coaster ups and downs in pricing. If you can take the knowledge that you're teaching people on this podcast and apply it in places like that, I think you've got a real recipe for success, especially in turbulent times like we're about to see. I mean, I fully intend to be in Fort Myers or Sanibel Island, Florida in the next year and a half or two, looking for, a lease option, a subject to deal on a very low priced beachfront condo.
Love it. For yourself to personally move into?
Yeah. Mm-hmm.
I love that.
As a vacation condo. Yeah.
Yeah. Awesome, man. Well, hey, I appreciate the time and wisdom. Wishing you the best. Hope you guys enjoyed this episode, and make sure to check out the show notes to check out everything on Paul and also Wellings Capital.
All right.
Thanks, guys.